What are the tax implications for commodity investments? Imagine turning your investment choices into a puzzle where each piece has a different tax rule. Understanding these rules can make a big difference in your overall returns. When you invest in commodities, taxes depend on what kind of investment you choose and how it is structured. Let's break down the main points so you can build your portfolio with confidence. First, if you trade futures contracts, the tax rules are a bit special. Gains from futures are taxed under what's called the 60%-40% rule. This means 60% of your profits are taxed at the long-term capital gains rate, which is usually around 15%. The remaining 40% are taxed at the short-term rate, which can be up to 35%. This rule applies no matter how long you hold the futures contract, even if you trade it within a single day. It offers a tax advantage compared to regular stock trading, where short-term gains are taxed as ordinary income. Next, let's look at commodity exchange-traded funds and exchange-traded notes. These are popular ways to invest in commodities without dealing with futures directly. If you buy a fund holding physical metals like gold or silver, your gains are taxed as collectibles, which can be taxed up to 28% if you hold the investment long enough. If the fund is structured as a grantor trust, gains might be taxed as ordinary income, which can be higher. When you invest in futures-based ETFs, gains and losses are often passed through to you and reported on a Schedule K-1 form. These gains follow the same 60-40 rule we talked about earlier. Some ETFs are structured as partnerships, which means you might get a Schedule K-1 from each year. This can make your taxes more complicated but also allows you to offset other income with losses from your commodity investments. On the other hand, exchange-traded notes usually follow standard capital gains rules, except for currency-based notes, which are taxed as ordinary income. There are also some additional points to keep in mind. High-income investors might face an extra 3.8% Medicare surtax on investment income, including gains from commodities. Also, the tax forms you receive can vary. Futures traders often get a Form 199B, while partnership ETFs send out Schedule K-1 forms. Some funds use offshore entities to simplify tax reporting, but that can reduce transparency and might requiring more active management. When building your commodity portfolio, it's smart to understand how each investment type is taxed. Knowing the 60%-40% rule for futures can help you plan better. Be aware that physical commodity ETFs like gold may have higher tax rates because of their collectible status. And always consider the complexity of tax reporting, especially with partnership structures. Consulting a tax professional can help you navigate these rules and avoid surprises come tax season. In the end, knowing the tax rules for commodities helps you make smarter decisions and keeps your investment strategy on track. Each type of investment has its own rules, so understanding them can help you manage your portfolio more effectively and keep more of your gains.